Welcome back, traders. Today, we are breaking down the language the market actually speaks, candlesticks. If you've ever looked at a price chart and felt confused by all those red and green bars, don't worry. By the end of this video, you'll know exactly what they mean, how to read them, and how to use candlestick patterns to make smart trading decisions. Make sure to hit that like button, subscribe if you haven't already, and let's dive in. What are candlesticks? First up, what exactly is a candlestick? A candlestick is a graphical representation of price movement in a specific time frame, whether it's 1 minute, 5 minutes, or 1 day. Each candlestick shows 4 important things: open, where price started high, the highest price reached low, the lowest price reached close, where the price ended. If the candle closes higher than it opened, it's green, bullish. If it closes lower, it's red, bearish. The body shows the range between open and close. The wicks, or shadows, show the highs and lows. Why candlesticks matter? Candlesticks aren't just random shapes. They tell a story, the battle between buyers and sellers. Reading candlesticks helps you understand who's in control, buyers or sellers, when momentum is shifting, whether a trend is likely to continue or reverse. Candlestick reading is essential for intraday traders because it gives you real-time signals based on actual price action. Single candlestick patterns. Let's look at some powerful single candlestick patterns. Doji, indecision. Open and close are almost the same. Watch for breakouts. Hammer, bullish reversal. Small body, long lower wick, found at the bottom of a downtrend. Shooting star, bearish reversal. Small body, long upper wick, found at the top of an uptrend. Marubozu, strong momentum. No wicks, just a full body candle. Clear buying or selling pressure. These are simple but powerful. One candle can signal a shift if it's at the right level, like support or resistance. Multiple candlestick patterns. Now let's step it up. Patterns formed by 2 or more candles. Bullish engulfing, a small red candle followed by a big green candle that engulfs it. Strong bullish sign. Bearish engulfing, opposite. Small green followed by big red, trend may reverse down. Morning star, 3 candle bullish reversal at the bottom. Red doji or small candle, strong green. Evening star, bearish version of morning star, found at tops. 3 white soldiers, 3 strong green candles in a row equals bullish continuation. 3 black crows, 3 red candles equals bearish continuation. Combine these patterns with volume or support, resistance zones for high conviction entries. Let's break down some real charts together. Here's a hammer forming right at a support zone. The long wick shows rejection from lower prices. Now watch what happens. A bullish engulfing candle confirms it, and price moves up from there. Next, here's a shooting star after a strong uptrend. The long upper wick shows rejection, sellers stepped in. Then, we get a bearish candle confirming the reversal. By combining structure and candlestick signals, you can make smarter entries and avoid traps. Candlestick tips and mistakes to avoid: always look at the context, don't trade patterns blindly. Higher time frame candles carry more weight. Use candlestick signals with support, resistance, market structure, and volume. Wait for confirmation, don't jump in just because you saw a hammer. Common mistakes: overtrading every pattern, ignoring market structure, not waiting for candle to close, relying on candlesticks alone without a strategy. So that's your complete beginner's guide to candlesticks. In the next video, we'll look support and resistance. If this helped you, drop a like, subscribe to the channel, and don't forget to hit that bell icon. Got questions or want a specific candlestick pattern explained? Let me know in the comments. Until next time, trade smart, stay safe.